Welcome on to Searching for Mana Matus Maar.
Thank you, Lloyd. Glad to be here. Thanks for the invite.
Absolute pleasure. For the introduction, Matus is a co-founder and managing partner at Talis Capital. They are a venture capital firm that currently deploys circa $100 million per year. Matus has led Talus deals within fintech innovators like Onfido and iwoca and many more. Recently, Matthias has spearheaded an initiative to provide mental health support for founders at Talis portfolio companies. So we want to take the chance to really deep dive into that topic. It's something that is very dear to my own heart as somebody who's founded a search business who is also trying to promote uh, wellness in environments that traditionally can be very competitive and demanding. Hence, the skulls in our logo are actually a play on that. So can't wait to deep dive into that. Matthias, what would be really kind of you is if you could just talk to the audience about what's going on right now um, with you and Talis Capital.
Sure. So, as with all VCs, this year was very busy. It was obviously a turbulent year, like for everyone. The Q2 was very challenging because everything was new. COVID was new. No one really knew what was happening. The markets were tanking at some point. And we come out of this really weird year with markets in the record highs, M&A activity, SPACs, IPOs, multiples on valuations, everything in sky high. I think everyone realized this year that obviously technology is the element that almost in any business will power growth and competitiveness. And it was going that way, but like every time you have this kind of years in history, it obviously accelerates all of the things that were clearly going to happen, but instead of 5 years, it just happened in a year, which is very interesting because obviously your thesis that or our thesis that we're going to see these things happen in 2 3 years 4 years times, it's just suddenly happened now. Completely new companies have been set up, and we can talk about it in terms of fintech. You see all of these things like remote teams everywhere. What does that mean for their payrolls and paying them and getting their taxes correctly, etc.?
Yeah,
Following regulations in all of those countries where you suddenly bound by geography, uh, which was kind of happening in engineering, but fairly new into all the other departments of companies. Um, and now companies realizing that, well, if we can be remote within London or within UK or within their own country, then suddenly the market for talent opens up almost to anywhere, which obviously in your own line of work you must see. And we see a lot of regulation tech, new companies coming up, and fintech companies that are trying to solve this. And so it's interesting. Things accelerate and things change, and so it's like for everyone. And the mental health, I think everyone somehow is suffering from this year in their own way, some more, some less, and in various ways. But obviously, um, founders and business leaders are usually the ones who, even in a normal year, find themselves much more prone to mental health issues, and this only just makes it worse. So it's something that we think about a lot more, but I guess that's why we're talking about it today. In terms of Talis, we had our busiest year ever. We deployed, I think, over $110 million this year. A lot of opportunities, it's a really busy time, and it's exciting time because um, there's a bunch of articles and things you can, people call it great stagnation, what we were in the last, let's say, 10, even 15 years. By a lot of adjusted metrics, the GDP growth has not really been exciting, not really that much innovation really happened. And I think that's going to accelerate now, especially when suddenly pretty much everyone has an Apple Pay now. It doesn't matter how old you are or what demographic you are, because, or people who, did not want to get an Ocado or Waitrose.com or whatever food shop accounts because they like to go local, they had to get those accounts. And once you use these things, it's not going to go away, even if the pandemic goes away. So it will stick. So I think it's the most significant change in how we live our lives and how we work in very long time. Probably the largest in my lifetime. So yeah, it's going to be interesting few years.
When you have so much opportunity, this happens in our world as well. I refer to it as looking across the ocean, and if you do that, it can become overwhelming, stressful. The skill set is really not looking for what to necessarily say yes to. It's how to eliminate, and then to focus on uh, some clarity where you feel you have an advantage of opportunity. So I look at the portfolio businesses, and I know you're at a stage now where there will be different strategies. But how are you clarifying that, as we've had what, as you say, is 2, 3, 5 years of progress compacted into a year? And of course, you've taken stock. Like you say, you've been deep thinking, you've been reading, you've been trying to evaluate. Where's that strategy at the moment?
So we are a generalist fund, but what we do a lot, and maybe more than other funds, is each year or every couple of years or whenever the timing is right, we really deep dive in certain, we call them theses. So we have kind of three pillars in terms of how we research. First thesis, which has been around since we started, we call it tech infrastructure, which for us is, we were always more interested in investing, let's say, in Onfido that powers all the neobanks than picking which neobank is going to be a winner or not.
Yes.
So
Okay.
it's been clear to us, that there will be neobanks and they will become big, but at the same time, the old banks will want to catch up with all the tools that the neobanks are using, and so everyone, the whole banking sector, will need remote ID verification. And that's on top of other industries. So hence, we would go and try to find an Onfido rather than, are we going to invest in Monzo or Revolut, etc. Although obviously those turn out to be really good investments. We are just more interested in the tech infrastructure that powers these things. And that goes through not just fintech, but, you know, um, our third thesis, before skipping the second one, the third thesis is on the new generations, because Gen Z, the oldest Gen Zers are, I think, 24, 25 now. They're, working. They're really becoming, and when that happens, every time that happens, that generation that becomes really influential. And so we're looking at things like gaming, but we're not going to look at gaming in terms of we're going to invest in the studio and that hopefully going to um, develop the best new game. We're looking again from the tech infrastructure piece. We have made a couple of investments recently, which are not announced yet, so I can't tell you what they are, but they are more powering the immerse worlds that gaming now needs. Gaming needs faster speed of everything. Everything is huge, and these are multiplayer worlds, and they have to have no latency, and they have to everything has to happen fast. So that's why you see a lot of even in the music and video, etc. A lot of the platforms that power these things were originally designed for gaming platforms. So we are looking more and more on the infrastructure. We don't
Yeah.
care which game is going to win, but we like the infrastructure layer, and that's kind of in a way that's what we were looking in, cybersecurity with our investment dark trace, all of that we see, or in construction. We think construction is the next big thing to be disrupted. Again, we like the tech infrastructure that's going to come in the construction. Um,
Yeah.
and then the third pillar is kind of how we live our lives, how we work. And under that, obviously, there's various things that can go to healthcare and healthcare tech. Wellness is part of that, but also financial management, just anything, education, for example, edtech. We think is obviously very interesting. Again, something that's been really accelerated by this year because suddenly all education or most of it had to go remote. 90% of students worldwide are receiving education remotely through COVID-19. That's huge. If you look at whatever the number was before, it's obviously a huge jump. And once people get to used to something, it's just going to stick. So it's obviously a huge area. So we have those three pillars, and then each year there might be like two, three under that thesis, like edtech, and then we particularly believe in some things within that, and we research that a lot.
Yeah.
So within fintech, we really looking at the regulation stack at the moment. For example, we're in the thesis of how we live our lives, which also cross borders to the new generations. We have added sustainability tech, so sustain tech. We believe that next 10 years, it's going to be really big for sustainability. It's something that the new generations are really influencing the older generations to really care about. It's something that the companies that will not adopt sustainability as part of their how they do business, they're going to really suffer, because the ones that will have that incorporated, they will be supported by governments, they will get their planning permissions if they need some faster. Everything will happen much easier for them. And so and this is, I think, the time where technology first time comes in and allows investments in sustainability or sustain tech that are going to give you venture style returns. Before that, the impact investing was always hindered um, by not returning the same as other areas, and so people saw it more as a charity.
Yeah.
Now, I think we believe technology is allowing these companies with core sustainability at their core to really give you huge returns. We have investment in something called Insect in France, which is built the largest insect plant that creates protein for food industry and pet industry and the feed material for all fish farms, etc. Amazing, because they're certified B Corp. They are they absorb more carbon that they create. They're clearly helping the fishing out of oceans and the ocean sustainability. But it's actually amazing business. The business model is great. The margins are great. This is what's happening now. That can happen because inside the plant, when they're feeding the insect, a lot of it is through robotics, a lot of it is through machine learning and computer vision. They can see the whole colony is the motility of it every time it's being fed, so they know if there is a disease. They can catch these things. That is only technology is allowing it to work. Otherwise, 10 years ago, this would not be possible.
When you're talking, Matthias, about the pillars and how you look at investments, I find it so fascinating because in essence, this must have come from you and your few founders a decade ago or so. What I'd really like the audience to understand is what the journey was for you. I think it's three others. I think there's four of you. Is that right?
Yeah.
How did you guys go through the process of establishing that you all had the same, I suppose, ethics and philosophy, but you were bringing a bunch of different attributes so the fund would be successful?
Yeah, I mean, we are, I would say, a little bit unconventional fund anyway. For example, we have annual vintage funds rather than just usual 3-4 years investment cycles. That's for various reasons. Our LPs are ultra high net worth business leaders or entrepreneurs. We do that on purpose. We have about 35 of them, super successful people from various industries who can write institutional size checks to us, but maybe they don't want to do that on necessarily 3 year or 4 year cycle. It works really well for us as well because we create a platform where every time we invest in a company, we we think how can that company benefit from some of our LPs, and then we plug them in. When we led the Series A for Darktrace, the first thing we did was get them in two of our LPs companies. That led into multi-million-dollar contracts with them, with those companies. So the Series B that Summit led for was 4 months after our Series A, because suddenly the ARR doubled, etc. So we try to think how we can create this opportunity, and then we have 35 of them now. There's various industries that they come from. There's always at least 3 or 4 or 5 that are somehow really relevant to a particular company we're investing in. And then on top of that, the way we started back in 2009, it wasn't necessarily the setup that we are now. Originally, the other two co-founders, Bob and Rohini Finch. Bob was the largest shareholders and very involved in company in the trading company before. They originally did not know what the theses are going to be. They just knew that um, they want to invest their wealth in private companies, and we came in, me and Vasily, and we really first had to educate Bob and Rohini on technology. This is 2009 and 2010. This is not like now when everyone gets it that this is the next thing. There was still hangover from I guess .com boom. The iPhone only just came out.
Mm.
A lot of these things were new, and it wasn't clear like now to everyone that technology is the one that's going to change everything. So, but we said, look, we want to invest for long term. We are not here to go and buy public stocks and trade them. We are not here to, even though we did a couple of private equity style investments, we did not want to do what private equity does, because that is basically flipping assets, right? You buy assets, you think you can do some things there, you bring some operating partners, you change management, you squeeze more EBITDA, and then you trade at the same multiple 3-4 years later, and you hopefully made 3 times your money. To
Yeah,
me, it's not it's just to make money. It's financial engineering to me. What I love about venture capital is that you are from very early stage with the people whose idea it was, who and you're going to be with them for a long time. You're going to go through the ups and downs. It's never a straight line. Hardly ever the business model that succeeds is the one that at the beginning was presented, and that's fine, because it's a lot more in what you're doing. Finding the talent that you see something in, that they will eventually succeed, and that's exciting. Obviously, you know we're fortunate enough or lucky enough that we have really great track records, good returns. It's great, but it's also a lot of fun. And so um, uh, that's how, I mean, it's a long answer how we started, but it was a combination of people who are super successful business people, but not in the technology space. But fair play to them, they got it really quickly. And from 2011, 2012, all we do is just focusing on technology investments, and they'd be great supporters of us, and they're part of the investment committee because, as I said, I think even if you don't come from technology background, you don't need to be an engineer, but if you're a super successful business person, you will ask the right questions. You will, in the end of the day, these are still businesses. Just because they are powered by tech infrastructure or they're doing something more digital than physical, it does not mean that you don't ask the same questions. So that's how we got together. And then from the very first theme that we had is the tech infrastructure theme, because back in 2011 and 12, we saw certain things like the first neobanks kind of starting to popping up more. This was 2012 when we backed iwoca. It was one of our first seed investments, obviously super successful. The founders are super clever. We loved them from beginning. They had the perfect combination of understanding fintech, coming from big banks, but also understanding how to write the algorithms. The two co-founders, one is more commercial, one is more technical. So it was perfect combination, and we believe that this is what's going to happen to the fintech space. It's going to get digitalized. Back then we were not talking about AI and ML as much. Back then it was still big data, um, which probably is actually more accurate for most of the people who claim ML anyway. But it's writing algorithms, looking at data, writing algorithms, and through that, iwoca, being able to in seconds decide who are they going to lend to or not. Um, when it first started, it was meant for Amazon and eBay and online sellers, where we got an API and you can just analyze, is this company or this person top seller on Amazon, and that kind of things. Obviously, it evolved enormously where it is now, but that's how it started.
So, Matthias, if I think about 10 years ago, or several, when I walk around peer-to-peer lenders or SME credit providers, regardless of what the website might have said, or people would say at a pitch, their decision science team would be a few people. It was very discretionary of how to lend. The difference now is, the majority of individuals in those businesses, as you say, have AI or ML capabilities. Most people would be competent with your, Python and R and SQL and so on and so forth. And so we've really seen the makeup of the individuals become technology and then finance in preference to finance and then digital. You're looking into the future, of course. How do you suspect it evolves even further? What are the technology trends that we look to see? And actually, I'm just going to ask: do you suspect that's moving on to the blockchain?
Before I get to the blockchain, I think um, the reason why we also invest in iwoca and where we're looking more B2B lending rather than B2C is that whichever way we looked at the consumer lending, we were just not comfortable with the ethics of it. I still think that is the case, and we just were not comfortable with that.
So if I just interject, there's some headline businesses right now who are in buy now, pay later business propositions. You wouldn't look at those type of businesses.
Not in the consumer side.
Yeah. Okay.
It's not it's we just not comfortable with that. And I know there is a lot of new business models which came up in since last 5 years. Some of them are get paid today what you earn already this month. So that's not necessarily lending because that's your money that you already earned, which kind of makes sense for some gig economy. These days people who are delivering your food or driving you,
Yeah.
etc. They might have 3 4 different jobs, and it's great if they can have it consolidated, and if they want to get paid not whenever that the company decides to pay, etc. Makes sense. I suspect, however, that if you need to get paid on the 25th day of the month or 20th instead of the last day of the month, it's probably going to leave you with some difficulty when you have to then pay rent on the first of the next month. So I still, just generally, it's not something that we find. I'm not saying it's unethical. We just not comfortable with that. We're not necessarily want to do that. Whilst with B2B lending to businesses, which traditionally, especially we like the SME space, because these will be businesses that might be doing well, but the traditionally how banks would look at them traditionally, it just was not suitable. Show me your last 3 years of profitable accounts. I mean,
Yep.
who could do that when you just started your buying and selling via Alibaba or something 3 months ago? Yet you
Yeah.
might have great business model, and that's why through data and things you can really get it much quicker. And I think that was the arbitrage there, where banks were so behind in SME lending and B2B lending, not using any of these tools, that there was a huge space.
The trend I'm looking at, uh, and now I believe it's a fundamental trend and not a fad, is that we move on to blockchain and then we build applications on them. This is obviously happening on Ethereum and Polkadot already, which look really exciting. It looks like we've got the big institutions into Bitcoin, and if you just think how there can be an evolution, I suspect DeFi probably is potentially one of the biggest trends of the next 10 years. But that's my view. I wondered what yours is, what you're looking at.
Yeah, I think we don't have that as a thesis, let's say crypto, but I think quite few of our companies are using distributed ledger technology for parts what they do. Most of it is for keeping things secure. Onfido does uses bits and pieces on that. Quite few companies in this space use directly or indirectly, or part of what the solution is. They use distributed ledgers. I think on uh, yeah, I think that's going to continue. I think it's a very good technology for security.
You yourself have founded a couple of companies. So so perhaps if we ask you, in your experience, how taxing can that process be on a founder's mental health?
I've been very lucky that even the companies that I have co-founded or been involved uh, since beginning, I am never the person who's the CEO. I am not the one who's everything's on that person's shoulders. But what I'm trying to do, with pirate.com or
Yeah,
thread styling, or recently a sneaker platform that we launched called Laced. It's just try to help. These were founded by people who run them, who absolutely understand the product market fit, and they have something special. They have special vision, but they're first time founders. And what I found and before is that if you're a first time founder, you don't necessarily know what the journey will look like. And even though people will tell you it's going to be the hardest thing you have done ever, people think yeah, but it will be great, it will be fun, etc. There's So what I'm trying to do, and my role there is, a being venture capitalist, help them to, when you fundraise, what is the good timing, all of those things, to being on the other side of a table. um, I try to help with when to do what hiring as well. When do you start looking for CPO or CFO, or where is more appropriate to, for next couple of years we only maybe need a tech lead. We don't, just help in how it really works, and it's working with great search firms like you guys. It's that's what I'm trying to connect the founders with, and we'll work on that, which is super important. When do you hire what? You can make a really great hire, but if the timing's too early, it's not going to work out. If you leave it too late, you are going to suffer. So these kind of more like what to do at the right timings. And at the same time, what I try to do is to be there if you have, and it's not if, but when there is challenges, which can lead to obviously mental health, because sometimes it is, and sometimes you do everything right and it's just the macro, or just you just unlucky, and it is challenging. It is what people don't realize. I think this is the hardest bit about being a founder, is that most founders I see, they start something because they have a great idea, a great vision, but as you grow the company, you have more and more employees. You if things are not going well, or if you're worried that things are not going to go well, it's never about the money. It's not like, oh my god, I'm going to lose money, because founders eat last anyway. They usually pay themselves the last. They everyone else gets the market salaries before they do, etc. So it's not about the money, or but it's about that they start realizing, well, I've got 50 people, and I really care about them, and it becomes, I don't know, it's a cliche, it was like kind of like a family. But most of them do really take the burden on, and then they realize, it's really lonely at the top. I can't be the one who's going to show any signs of weaknesses or worry. I have to be the one who will tell everyone, no, no, it's fine, it doesn't matter, that's okay, it's going to be fine. And I have to do it really convincingly, because if it's just not convincingly, people can tell. And
Yeah.
so they are in this mode that everything is fine all the time, go go go, positiveness, etc. And they don't necessarily have anyone. And I think what we are trying to change at Talus is that we realized, well, they don't even have us as their VCs or board members to talk about, because in front of us, they have to be again the same. They have to go, no, no, everything's fine, everything's great. Yes, I know this quarter does not look good, but it's and so what we're trying to do, more and more, is, yes, there are board meetings, but that's kind of, it's not important to me necessarily. It's something, I'm much more likely to catch up every couple of weeks or once a month, one on one with the founder, and just be like, okay, just don't give me some graphs on how the performance is going, just like, what's worrying you, what's really happening, and just trying to encourage, the founders to be true and real. And I always say to them, like, look, I can't take the investment back. I'm not going to, you know, disinvest. And we are together on average, I think it's 7.3 years from Series A to exit. It's a long journey together. I'm not, just, it's not, nothing is going to change if you're going to tell me really how you feel. And I know that it's not always going to be great. And you can tell me, and maybe I can help, or maybe I can just listen, because sometimes just listening is what sometimes people need, who are suffering, at that moment. So that's, I mean, consciously we're trying to do that. Consciously I'm trying to do that. Consciously I'm trying to go on less boards, to be honest with you, because once you are a director on the board, that comes with fiduciary duties. So, you have then fiduciary duty to, the company, and that goes to that goes in the order of company creditors, company employees, not even to other investors, not even to the founder. So then you just might become conflicting if you actually really want to just help the founder to succeed. And you are obviously, we always have a fiduciary duty to our own investors, but that's easier to overcome, as a conflict, because I can argue that, being close to the founder and just really helping them, and is always going to even eventually going to make that more likely to succeed.
Absolutely love the mentality of what you talk to there. I'm second time founder. Not to make it too much about myself, but on the first company, there was a moment where a couple of years into it, I literally collapsed physically. Tried to open a door and just collapsed. And it was because the makeup of the team that I brought in was incredibly junior, also, and so I had to project this extreme confidence the whole time. And actually, things were going really well, but nonetheless, there was never a soundboard that I felt gave me the support that you're talking about, because the individuals who were peers or investors, clearly I understood that behind the smile they were looking for the graphs and the this is awesome that you have to project. And so at that moment, I was like, okay, I need to take this really seriously. I can't, before going to bed, be reading business strategy books the whole time. And I have to build this support network around myself. And so I went and found a bunch of people who didn't really have an invested interest in the business doing well, apart from feeling like they could give me some support. And that was a seminal moment in the difference of how my stress levels uh, were when I was operating in the business. And I'm really lucky this time round that there's a bunch of people in the business who are certainly my seniors, peers, and juniors, and I've just learned to be a lot more straight with people. So of course you've got to caveat anything when you're catching that it's not going quite how you want it to, but I'm comfortable to do that as long as I feel like the business all um, as much as possible are enjoying their work and feel like they're on a mission that's greater than them, then we're all in it together. So it's something that I slowly learned from founding a second time. Um, what I've been seeing over the last year um, during the pandemic is almost, if somebody's fragile, it's like a car might be able to go at 30 miles an hour, and if you race it at 100, it can break down. And I feel like um, the pandemic has done that for a lot of people's mental states, and maybe no place more than high growth founders. So I wonder how you and Talus have seen the change and what you're doing about different levels of supporting founders and your community through the time.
It's really difficult to replicate strategizing, being kind of just talking. It's just very different. It's just hard. And sometimes when you in the same space, just one remark there, one remark there, you can have impromptu conversations without scheduling them. It's that is something that I think I can see that even people who are doing well as their companies and revenues are doing really well, they have still struggled in the
Yeah.
pandemic. So what we have done, um, and we talked about this, it actually came up at one of our team meetings in the early last year, in the early stages of the pandemic, and we were saying to ourselves, like, we are suffering ourselves and we're just a small team, because the beauty of venture is that you don't need that many people. That's the beauty of it. We're a small team, we're about 15 people, but we are struggling. Like, how our portfolio companies, the founders, I mean, they must struggle so much more. It must be really hard. What can we do to help them? And then we came up with, like, well, why don't we ask them rather than just guessing? So we went to all of our founders and all our business leaders, and we asked them, and overwhelming top ask was, well, I would like to know how to spot that other people, my peers, or even myself, are suffering, just to
Yeah.
detect it first, rather than, because sometimes you have every half an hour new Zoom, blah, blah, blah. Again, you're not in the room with someone, you're not really getting the subtle signals. How do you get it? So that was quite eye opening for us. It was by far the most answered kind of question, that's what people want, and how to then deal with it, because a
Yeah.
lot of the founders not necessarily had a training how to detect it with someone, a colleague or someone, how what should you do. So we partnered up with a company that helps us run these workshops. So we have done series of workshops for our founders that were paid by us, free to obviously join for the founders and even the executives from the companies. And I think it was really great. I mean, a lot of great feedback. People, I was almost, I don't know why, but surprised. People, almost all of our companies came on these workshops. They found it really interesting, and then we were like, okay, well, this is really good. We got really great feedback. People really loved it. It's like, what can we do next? So obviously now, let's say they have learned how to detect it, how to little bit talk to people who are suffering or deal with it a little bit, but how can we give them more training and more tools to, even for themselves and for their colleagues, to deal with mental health. And so we have not launched the second phase yet, but we're about to, which will again be covered by us, and we're teaming up with a different a provider who's doing. It's going to go a lot deeper, so it's going to teach various things for our founders and executives. There's a couple of Americans. I don't think we have seen anything like that in the US. There is a fund in Europe. In the US, there is a fund called Alpha Bridge, which has created this, I think, portal or whatever you want to call it, a tool or a program for their founders. I think they call it Atlas, which is really interesting, and we have looked at that as almost something that resonates most with us, because everyone else provides and historically provided to their business leaders maybe how do you become better leader in terms of your performance and your management skills and things like this, but not necessarily how do you deal better with mental health issues. And so and there is some good statistics. I mean, you can go on Alpha Bridge website. They have done really great job to do that. They have done a lot of surveys, and um, I think it's like 50%. 50% of entrepreneurs are likely to report on themselves mental health condition. I mean, that's huge.
Matus, I wonder if part of what makes a majority or a portion of successful entrepreneurs, or quite frankly, business individuals, I don't want to say is having a mental health issue, but actually um, is having some ability to be an outsider, have an outside perspective. There are, talking of statistics, um, if you look at in the 80s, the individuals who are at the top of investment banks, when surveyed, came out relatively high on the psychopath test, right? And this is because at that point, some of the traits that would allow you to get to the top and succeed were Machiavellian and were ruthless and meant turn up early, finish late, you know, big effort, and quite frankly, cutthroat attitude in business. If we look at somebody as an example that everybody would know, like a Steve Jobs, um, there's this Marmite reaction to him, which is either, well, the products are fantastic, I really love them, or he's a complete bastard and incredibly ruthless. And these two things made him a great innovator and a perfectionist. Um, so it's tough for you because, and everything that you've said on the show so far, I know comes from wanting to do the right thing. Can tell with the way that you talked about consumer credit lending and so on and so forth. And so that's awesome. But this is tough because a lot of the traits that you might be looking for in what you deem as a successful founder could come from some type of outsider mental health perspective. But of course, all you can really do I think, or one of the things you can do is go, this is probably going to be a 7 to 10 to 14-year journey. How can I protect their wellness through it? But it's convoluted. How are you thinking that through? What are you seeing there?
Well, I think a lot of the things you said about the investment banking, etc. I mean, it's still an industry that I would not wish to work in, but I think improving. Yeah. Um, what you said about and I think those were just excuses, right? You can take away all the sexism and all of that doesn't make you like, you can be ruthless in terms of determination, and you can be ruthless in a way that, look, I'm not going to necessarily carry people who I don't think are good for the company, because at the end of the day you're thinking, well, if the company succeeds, it will employ a lot more people, and therefore I'm going to create a lot of jobs, etc. But to do that, I do have to get rid of sometimes people who are just not a good fit, or not performing well. So you can be ruthless in determination, but how you do it, it does not have to be the 80s investment banking, I
Yeah.
think. And then your example on Steve Jobs, look, if maybe he was suffering himself, maybe if he got help, maybe he would be as determined and as brilliant as genius as he was, but maybe he wouldn't be as much of an asshole as some people claim that he was. Maybe even if we just improve by 10% uh, the founders' mental health themselves, maybe they will become better leaders, and they can maybe cope with it all better. And therefore, you know, it's just small improvements. But I think if we can make that improvements, it does not mean that, we are not going to look for the most driven people with the biggest vision to change the world and do what they're doing in there. That doesn't change. We're still going to back the people who are that, but we think that no one is giving them, or there is very little support on the mental health side, and we think that it can make change.
Matthias, absolutely love what you guys are doing, and thank you so much for your time. Um, I'm gonna say that your Mana is bringing wellness to the founder community and supporting them, and fully um, respect that. I'd just like to finish giving you the opportunity to perhaps give any condensed advice to um, founders or anybody in high growth businesses or anyone you want to talk to that you think would be really useful.
Well, thank you so much having me. It was a pleasure, and I really really resonate with with your questions. And maybe I'll flip it onto you this last question, because you know you said you've done it a couple of times. One of the things you said is how you constructed your team around you. That was one of the outcomes that you have. That was big improvement for you. What else is there, do you think? What else did you learn, and what else you're doing different now, and what would you give in advice?
Um, yeah, so I
Genuinely interested, because obviously there's not that many serial entrepreneurs, so it's good to know. And I think, just before you answer that, maybe gives you a second just to think about that. But that's the trick in the venture capital as well, because you would think, oh, well, we're only going to back people who have already done it before. The trouble is that we're all, once we have done it something so hard already, sometimes it's difficult to do it second time. And even people
yeah,
think that they can do it second time because they had some time off. When they come back into it, they might realize that, why am I doing this to myself again? And so there is no
absolutely.
kind of a formula on that.
So I speak the whole time to CXO founders, um, and at the point where, from an outside perspective, they're incredibly successful. They typically at that point have a lot of paper money, but they're looking, and I'm like, why are you looking? Like, take this to a close, like this is then going to allow you to either go perhaps into venture, perhaps you can be an operator and have refined what you're focused on, or just go peace out, whatever it might be that you want to do. And the difference in the response comes from why my whole business is called Mana. It's what are their drivers. And so for me, my driver was very much always I was going down the path of professional sportsman. This is very cliched. Didn't happen for whatever reason. So there was an ability to captain, an ability to be good at self motivating, but then it needed to be aimed at something, which wasn't sport anymore. And I was interested in the economy, and I was interested in psychology. And after some derivatives trading, I found headhunting, and I walked into the space and was like, okay, this is amazing. This brings all the things I love together. And the really key thing was it's terrible. The industry is absolutely ripe for disruption. So I can be an entrepreneur when I've learnt in this space. And so after some experience, I went and founded, and I just learned a load from that experience. And maybe the most important thing that I learned was what I was talking to, which is how to manage myself, how to have patience with my ambition to, see the vision come to fruit, and how to surround myself with a support network. And then there's a whole load of practical things I did where I drew various lines, which are to do with, as mentioned, looking at like just being myself, not trying to put a corporate veneer on it. Um, okay, what is it that I really enjoy that's nothing to do with this? So I do a lot of painting, where I can completely relax and switch off, and it has absolutely no ego attached to it. I don't think I'm great. I'm not trying to commercialize it. And I since have had a family, so I have a daughter and a partner, and I make sure that there's time where, well, that is the sole priority. Everything else comes in phases below that. And so I just think nothing would surprise anybody. It's like when you read a great book, you're not necessarily saying, hey, that page is something I've never heard before, but it's just being conscious of all of these great tiny little hacks. But I think the main one is when I wake up, I absolutely love what I'm doing. I wouldn't want to do anything else. And I find myself now for sure working on weekends, but it's because I really want to do it because I'm really excited about what I'm doing. It's not driven by ego or stress. And it's like you say, absolutely not to do with money. It's just this is my passion. And so I'm very fortunate to have found what that is. And then just make sure that um, my time frames don't put pressure on me. The definition of stress is when you perceive that you have to achieve something in a time frame that is less than what you have, and so therefore this is something that you have to manage very well, I'm sure, when people are considering what their runway is. For me, I've really controlled those and I've put them into the future, and I'm realistic with them.
Yeah, that's great. Yeah, I agree with those. Uh, yeah, I think I think self care. I think a lot of times self care comes last with founders, and because it's almost like they feel guilty that they're not working every single minute. What I try to say sometimes is that, well, okay, take it rationally. If you do the self-care, if you maybe do take um, half an hour and go for a short run at the lunchtime, you'll be more productive in the afternoon.
Yeah,
It's chemicals, it's proven, so you don't have to feel guilty about it. It's scientifically proven that you will do better job doing that. Get up and take the time to get dressed properly, and those things are important. The small rituals in every day, do not abandon them because it's a slippery slope.
I completely agree. Well, I'll hopefully carry on these conversations with you separately. I
That
like
would be great.
I like the sound of some of the companies that you're investing in, and I suppose it's along with what you can do for your founders, where you can make a huge impact on everybody's wellness, particularly now it's moving digital. Matthias, thank you so much for your time. Absolute pleasure.
Thank you, Lloyd. It was a pleasure. Thanks very much.